Tax season just ended, and you've seen your last year's numbers in black and white. 5 months into the year, if you're an entrepreneur or a business owner, that means that you have something that most people don't get until December, a real honest look at how this year's shaping up. And this makes May the perfect time to ask a question that most owners don't ask. Am I actually paying myself the right amount, and am I doing it the right way? So let me explain why this matters and why most business owners get it wrong in one of two directions. When I first start working with entrepreneurs, I see the same two mistakes over and over again. The first is that you're underpaying yourself. You're plowing everything back into the business, telling yourself that you're going to catch up later. Meanwhile, your personal financial goals, your retirement savings, your kids' education, quarterly tax payments, and your household emergency fund are starving. You're building business equity, but neglecting personal wealth. And here's the kicker. If something happens to the business, you don't have anything to fall back on. Now, the second thing we see all the time is the opposite. People who overpay themselves. You're pulling money out faster than the business can sustain. Business cash flows tight. You can't reinvest. You can't hire. You can't weather a slow quarter. And you're treating the business like an ATM instead of an asset, thinking that future growth is going to fix the pressure that you're always feeling. And the right amount to pay yourself sits right in the middle. And that middle is not a feeling. It is a specific number. So here's the framework, and here's how you can think about it. First, let's start with your personal number. What does your household actually need to fund your lifestyle, your retirement contributions, your tax payments, and your savings goals? Now, this is not what you're spending. Lifestyle creep, that's another conversation for another day. The number we're looking for today is the number you should be funding to stay on track with your personal financial security. That is your floor. Then, take a look at your business number. What does the business need? And if you're not sure, check out our March One Thing video where we did a deep dive on business cash flow planning. There's a link in the comments. Now, getting our focus back to May, we're looking to clarify what the business can sustainably pay you without choking growth or leaving you exposed for a slow stretch. A common framework I use with clients is, well, there are a lot of different common frameworks, but the owner's pay plus taxes plus retirement contributions should typically land somewhere between 5 and 70% of your total revenue, and that is a massively wide margin, right? So let's break that down a little bit. If you're someone who follows the profit first method, you know that aspirationally we're looking for 40%. If we are in retail, our inventory costs are going to be really high. So, we're going to be towards the lower end, maybe 3 to 10%. If we're in construction, that might be 8 to 12%, manufacturing 5 to 15, services and consulting, these are a little bit higher margins, so you could be 15 to 35%, and restaurants are tough due to labor and food costs. That might be 3% to 9%. So the key here is to really figure out what industry you're in, what the percentages are, and what kind of the gold standard is, and then that's what we're going to aim for. So stepping back from there a little bit, let's think about you as a business owner. If you're in a growth phase, you might set a base salary towards the low end of your industry range. And then you might bonus yourself quarterly with excess profits that are more than the business needs. And that's going to increase your total percentage, total compensation. But ultimately, right, the right owner's pay, that number sits where those two things overlap, what your life needs and what your business can sustain. Now, how you pay yourself that number is where the structure of your business matters quite a bit. If you're an LLC taxed as a sole proprietor or a partnership, this is straightforward. Every dollar of profit flows through the entity and it gets hit with both income tax and self-employment tax of roughly 15.3% on top of your regular tax bracket. It's quite a tax bite there. But if you're an S-Corp, or if your LLC is taxed as an S-Corp, I should say, you have a lever that most business owners don't fully use. You can actually split your pay into two buckets, a W-2 salary and an owner's distribution. The W-2 portion is subject to payroll taxes. And because of that, the distributions you take later are not subject to self-employment tax. And that distinction can save real money because you're avoiding that 15.3% tax on all the distributions. So A couple things we want to talk about here, right? The IRS requires that your W 2 salary be reasonable compensation, meaning, how much would you have to pay someone else to do your job? And if you pay yourself too little and have distributions that are too high, you're inviting an audit. The IRS has been increasingly aggressive on this, especially with single owner S Corps. So the strategy isn't to minimize the W 2 to zero and take massive distributions, but it's to find a defensible salary and take the rest as a distribution. A reasonable starting point for many service-based S Corp owners is roughly 40 to 60% of a total's owner comp as a W 2 salary, with the rest as distributions. But the right answer depends on your industry, your role, what comparable employees earn, and your total profit. For example, a surgeon owner and a marketing consultant owner shouldn't be using the same number. Here's another thing that most business owners miss. Your W 2 salary also determines how much you can contribute to retirement plans, like a solo 401k or a SEP IRA. So if you set the salary too low to save on payroll taxes and you cap your retirement contributions, that short-term tax savings can actually cost you tens of thousands, if not hundreds of thousands of dollars in long-term wealth building. So here's why I'm bringing this up now in May instead of in January or December. In January, you're guessing. You don't know what kind of year it's going to be. In December, it's too late. You're scrambling to make year-end adjustments with no runway. But in May, you have 4 full months of revenue data. You can see the trend. You know whether you're ahead or behind of last year. And you know whether your big client renewed. You know if your costs are creeping up or stable. So May is the month where you have enough information to forecast realistically and enough time left in the year to actually do something about it. If your owner's pay is off, or if your salary versus distribution split needs adjusting, you have 7 months to course correct. So here's your one thing for May. Block 30 minutes this week and ask 3 important questions. What does my household actually need me to be paid to stay on track personally? What can my business sustainably afford right now, given what I know after 4 months? If I'm an S Corp, is my W 2 salary defensible as reasonable compensation and high enough to support the retirement contributions that I want to make this year? If those 3 numbers don't line up, you've found your project for the rest of the month. Get these numbers aligned and pay yourself with confidence, clarity, and intention. I'm Taylor Nissi, and this is one thing this month. One idea every month to help you make smarter decisions with your money. If you're not sure whether your owner's pay is in the right zone or whether your S Corp structure is actually working for you, reach out. This is the kind of planning we do with our clients all the time. So see you next month, and thanks for watching.